Good morning. Welcome to Chaikin PowerFeed, your daily market digest. Today is Monday, September 24th, 2018. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at Dan Russo _CMT. PowerFeed TV brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and Stock Charts TV. Sign up to receive Chaikin PowerFeed for free by heading over to www.chaikinanalytics.com/PowerFeed TV. Hope that everybody had a great weekend. Let's dive right into it. U.S. equity markets were mixed last week. Dow and S&P hit all-time highs. The Qs and the small caps actually traded in the red. Materials, fins, energy, and industrials were some of the biggest gainers in the defensive-leaning sectors like the Utes and the REITs. Underperformed. Technology was also down slightly. Treasuries extended their recent pullback. The curve steepening. 10-year yield pushed as high as 3.09% and not far away from those 2018 highs, which we saw in May. The dollar index was down 70 basis points. Gold finished a little bit higher on the week, and WTI crude had a nice week, added 2.6%. As we said, outperformers were the materials, the financials, energy, industrials, healthcare, and consumer staples, while the utilities, the REITs, tech, telecom, and consumer discretionary were your underperformers. And as we get to the desk this morning, S&P futures are down about 10 basis points. Asian markets were mostly lower overnight, but both mainland China and Japan were closed for a holiday. European markets are lower. Treasuries are roughly unchanged to slightly weaker. The dollar is firmer following back-to-back weekly declines. Gold is up 20 basis points, and crude is adding nearly 2%, up 1.8% here in the pre. So as we look at the S&P 500, we are trading near all-time highs. I think support comes into play at the gap higher from Thursday, 1915 level, we'll call it then. That's 2915 rather. 2873 is the key breakout, 2800 round number, and 2750 is your rising 200-day moving average. I'm calling resistance right now kind of the 2840 to 2850 zone. We got as high as about 2940 rather. I'm got my numbers messed up today. Resistance is in the 2940 to 2950 zone. RSI remains in bullish ranges, and Chaikin money flow is bullish. Kind of got to 2950 on Friday before fading, starting in the late morning. So again, we're feeling out resistance zones here. We're seeing what works. We're seeing where the market naturally stalls. All else being equal, we've broken out of the consolidation, and the secular uptrend is resuming. We are cognizant of sector rotation. Here you can see solidly in bullish ranges for the RSI, and Chaikin money flow is bullish. Your market in a minute. Here's what we're talking about in my note to Chaikin Analytics clients today. Dow and S&P start the week near all-time highs. 10-year yield near its highest level since May. Falling dollar last week's kind of supported commodities and materials, and I would go as far as to say they supported emerging markets on the week as well. We're going to take a look at one of those charts today. And we're watching financials as rates move higher. Futures do point to a slightly lower open, as I said. You can see on Friday the Dow was the only major index up on the day, rose 24 basis points. We now have 14 bullish or very bullish Dow stocks and 0 bearish or very bearish Dow stocks. S&P 500, 132 bullish or very bullish stocks, 49 bearish or very bearish stocks. NASDAQ underperformed, 26 bullish or very bullish stocks, 12 bearish or very bearish stocks. Small caps continue their underperformance as well, 364 to 304. Slight uptick actually in the ratio on a day-to-day basis, but the underperformance does remain. According to the power bars, large cap stocks and small cap stocks are bullish. Major indexes are mixed. Stock of the day. Every day, our PowerFeed subscribers, we will auto-generate a potential stock idea for you. It's based off of our proprietary Chaikin Power Gauge rating, and today's stock is Range Resources. Ticker symbol RRC, closed at 1749 on Friday, down 1.85%. Has a very bullish Chaikin Power Gauge rating due to very strong earnings performance, attractive financial metrics, strong price volume activity, as well as positive expert activity. So when we roll up the factors within each of these categories, we come out with a very bullish rating. So we have a very bullish stock with a strong trend. However, it's in a weak industry, right? We've been talking about E&P for a while being weak. even as oil moves higher. But there's an interesting setup here for range because it's trying to push through. It's trying to push through these highs. And so far it's fading, kind of call it 17, 17.5 to $18, $17, $18. So we have a very bullish stock with a strong trend, but in a weak industry. Market just beginning to agree with the model here as the dynamic duo is just getting into gear. Money flow bullish above the rising long-term trend line. However, the stock is overbought. So what I want to see is, number one, I want to see if there's an improvement in the industry, right? We like to buy strong stocks in strong industries when they become oversold. That's not the setup that we have here right now. Trading near the upper volatility band. I think the best case scenario for Range Resources right here is to add it to a bullish watch list. Look for a consolidation here in the $17 to $18 area so that it becomes oversold. If the industry firms up, you'll have a setup for a potential trade to the upside. So I'm adding Range to a bullish watch list. However, it's not there for me right now if I'm, being intellectually honest and following my process. Range Resources on a bullish watch list, but not going to go into a portfolio. Sector tracker, looking at movement over the last 5 days, we can see that bounce in materials as the dollar has weakened and commodities have strengthened. Financials getting a lift from rising interest rates. Energy, nice little rally up over 1% over the past 5 days as oil's traded higher and the industrials have come on. Healthcare is that emerging group of leadership that we've been talking about. On the bottom of the coin, kind of what you'd expect, right? Utilities and real estate underperforming. If rates are going to help the financials go higher, obviously it makes sense that they could hurt real estate and utilities, hurt your bond proxies, and push those to the downside. So we've been in the rising rate camp for a while, and now we're breaking out and testing the May highs. We'll see how that plays out, but we're also going to get a Fed decision this week where they're widely expected to raise rates by 25 basis points. Our industry in focus today is capital market services, and this one has not been pretty. Over the past 6 months, capital markets services subsector has underperformed the S&P 500 by more than 10%, and the power bar ratio, which measures future potential, is weak. It's currently ranked number 17 of 21 subsectors that we track. It has 11 bearish or very bearish stocks and only 4 bullish or very bullish stocks. And some of the indicative names here, all with very bearish power gauge ratings or Wisdom Tree Market Access, as well as Eaton Vance. Now, as you can imagine, with this level of underperformance, these two stocks are actually oversold. At this juncture, I don't think they make sense for a short sale idea, or even, if you own them, maybe I like to wait until the stock gets back to overbought conditions. But let's take a look at Eaton Vance right now. Very bearish stock, weak trend, but in a strong industry. Within that group of services, the investment bankers and managers have actually been holding up pretty well. But we'll walk through the process here. We can see the ribbon at the bottom of the screen tells us where the power gauge has been for the past 12 months. And you can see it was neutral until late May, early June, and then it turned bearish. Right around that same time, stock began to underperform relative to the SPY. So the market and the model are in agreement, and we can see very clearly the intensity of that underperformance. I mean, this is pretty much the polar opposite chart of the S&P 500, right? Up and to the right, down and to the right here for Eaton Vance. Stock is currently overbought with bearish money flow, and it triggered one of our sell signals today. It triggered our overbought sell signal. It's one of the 6 signals that we have proprietary to Chaikin Analytics, and they kind of alert you to opportunities. So notwithstanding the strong industry group, I think it makes sense to sell some Eaton Vance, ticker symbol EV. If you own the stock and you're looking for an opportunity to get out of an underperformer, I think that this is it. For those looking for an opportunity on the short side, my process. I prefer it to be in a weaker industry group as well. But I think that, as I said, if you're long Eaton Vance, here at the $54 level, it's overbought with bearish money flow and trip to sell signal. I think it makes sense to think about pruning that one from the portfolio or trimming it. Trending yesterday's or Friday's S&P 500 movers, IPG Photonics caught an upgrade that sent the stock 4% higher. No real news on AAL, American Airlines, to send that stock up. United, Under Armour rather, ticker symbol UAA, neutrally rated. On Thursday, they announced a restructuring. Markets seem to like that. Stock traded higher throughout most of the day. And then the stock caught an upgrade. So that stock traded up nearly 3%. Kroger, kind of trading higher, up to 2.6%. UNM, a very bullish stock, up 2.6% as well. My digging couldn't find any news as to the rationale behind that. There doesn't always have to be a reason. Very bullish stock going up is what we like to see. Copart down 6%, following through off the previous day's decline of over 13% following their earnings disappointment. Stock did catch a downgrade. Twitter down 4.5%. That's one of the names that's moving into the new communications sector out of IT services. So we're starting to see some stocks get move around on Friday in anticipation of that. Twitter is one of the names that's moving. It's a bearish stock. It was down 4.5%. DRI had earnings out, did catch a downgrade today. That stock is neutrally rated, down 3%. Micron down following their earnings disappointment, and no real rationale behind the 2.65% move lower in Chipotle, ticker symbol CMG. So let's kind of walk through what we're talking about today. It's Monday. It's Macro Mondays. In my note to Chaikin Analytics, clients kind of look at big picture themes and trends playing out across asset classes. And the one that really caught my attention was the breakout in the 10-year yield. We've been talking about it for a while. We've been talking about that consolidation while saying that we think the path of least resistance is higher. I mean, the Fed has told you they are going to raise rates. We finally got that breakout over 3%, which now becomes support. We're above the 50-day moving average. We're above the 200-day moving average, and we'll now contest with the May highs around 3.1%. Wouldn't be surprised to see some churning here, especially as the RSI for the yield has become overbought. But ultimately, we think rates are going to continue to move higher. A lot of people are going to try to point out that rising rates are a negative for equities. We've done the work. And they're not a negative for equities until they reach about 5%. However, you do need to be aware of sector rotation. Obviously, the bond proxies are likely to underperform in this environment, and financials are likely to outperform in this environment. Actually did some correlation work last week, and the group most correlated, one-year correlations, group most correlated to rising rates is actually consumer discretionary. And I think that that's interesting, especially because we think that rates are rising within the context of a stronger economy. We're watching financials as emerging leadership as a result, right? Here's the XLF, the Financial Select Sector SPDR Fund. And you can see we've been consolidating since the top in January. Moving sideways, has not broken to new highs yet. Still above the rising 200-day moving average, which has been nice support. But again, they've been an underperformer. The market's up and out. Financials have not broken out yet. However, in the middle of the range here's that 10-year yield chart. We can see the move higher. And below that, I put the correlation of XLF to the TNX, and this is a 65-day correlation. So roughly 1/4 correlation. And you can see that it's generally positively correlated. Financials are generally positively correlated to the direction of the 10-year yield. So as the 10-year yield continues to move higher, and in particular, if it breaks through that 3.1% level, I would not be surprised to see financials come on as an emerging leadership group. Keep an eye on the fins. Dollar weakness helps the emerging markets. Here's the UUP. We've seen it before, broken through the 50-day moving average from above. Still above the rising 200-day moving average, but the RSI seems to be in the process of shifting to bearish ranges, right? So we were on watch for a breakout. Now it looks like this could be called a false breakout in the dollar, and now it's moving lower. And to the extent that the dollar moves lower, that could be a headwind for the emerging markets, which have been in just a massive downtrend. Emerging markets have not rallied. Global markets in general have not rallied. So we'll continue to watch the dollar for signs of emerging market strength. And to the extent that emerging markets do break out, what does that mean for commodities? What does that mean for the materials group, which has been so weak as well? These are the intermarket relationships I am looking at on a daily basis. If you like what you're hearing here every day, help us spread the word. Share our link on social media, www.chaikinanalytics.com/PowerFeed-TV. Have a great day, everyone.